Welcome, dear all participants. Within the scope of Yaşar University Graduate School Seminar Series, today Dr. Eser Arısoy will give a seminar titled Eponymous Hedge Funds. Dr. Arısoy is an associate professor of finance at Non-Economies Business School. Having completed his PhD at Bilkent University in 2007, he held several positions at Essex School of Management, Lancaster University, and Paris-Dauphine University. His work primarily focuses on the three major research areas: empirical asset pricing, performance and risk-taking behavior of hedge funds, and whether and how behavioral biases impact investments and asset returns. He has published in Journal of Financial Economics, Journal of Banking and Finance, as well as other field journals in economics and finance. His work has been semi-finalist in investment category at the FMA 2015 annual meeting and was awarded 2016 Crowell Third Prize in recognition of his contribution to connect theory with the practice of quantitative investment management. In addition to regularly reviewing papers for journals and conferences, he serves as a member of the research committee and the scientific coordinator of the complexity of problems, solutions, and decisions, a sub-area of the complexity advantage area of excellence at NOIMA. Before the presentation, Professor Mehmet Umutlu, who is the head of International Trade and Finance Department, will give a speech. The stage is yours, Professor Umutlu.
Thank you, Pelin. First of all, I would like to thank Dr. Arısoy, Eser Hoca, for accepting our invitation for the webinar organized by the Department of International Trade and Finance at Yaşar University. It is our pleasure to host you as a guest speaker. I really wonder your findings about this interesting topic. And as we have just mentioned a few minutes ago, this is a very recent paper of yours. And as you mentioned, it will be the first time that you present your fresh results. And I hope the potential feedback that can be received during the questions and answers session at the end of your presentation will be helpful and constructive. And I wish you good luck in the publication process, and we look forward to listening to your presentation. The floor is yours.
Well, thanks a lot, Mehmet. Thanks for the kind introduction, and thanks for the invitation to present our paper in your seminar series. And thanks for having me. Yes, this is a very, actually, we have been working on this paper for almost 2 years now, but this version, we did like a major revision after presenting it in several seminars and conferences. So this version is just out of the oven, let's say, and it's quite fresh. So this is the first time that we are presenting it. So I look forward to all your comments and suggestions that can help us further improve the paper. So this is a joint paper with Vikas Agarwal from Georgia State and Tri, who's a colleague at NEOMA. So the paper is about eponymous hedge funds. So the time we started this project almost 2 years ago, it was Tri basically who came up with this idea. I had no idea what eponymy meant, what eponymous meant. So I mean, my English is not that perfect. So I actually, then I did a several search, and basically eponymy actually comes from the Greek word onyma, which means name. So actually you might be using synonymous, anonymous in your daily life when you're using English phrases. But eponymy relates to actually, according to Merriam-Webster dictionary, something relating to the person or thing for whom something is named. So basically, if you name your company, for example, after your name, such as this guy, Fisker, who named his car company after his name, Hendrik Fisker. So this is called an eponymous company. So what we are doing in this paper is we are looking at eponymous hedge funds. So eponymy is a commonly used naming strategy in business. So you see all these examples from Ford Motor Company, Bell Telephone Company, all these guys put their names in their companies, including Yaşar Holding and your institution. Actually, Yaşar University is an eponymous institution. So I think the choice of this paper, presenting this paper, maybe you might also get some ideas, or it can also ring some bells in your minds.
Great fit. Thank you for
Exactly.
this
So
selection.
I mean, that's why I was hesitating between two papers. The other was also an interesting one, but this one is really, I think, fits with your institution as well. So Selçuk Yaşar, he put his name to his business, and when he established this university, he put his name. So the question is, why do people do this? And this is also a common practice in finance, like all these major financial institutions, JP Morgan, Goldman Sachs, they are all named after their founders. So this guy is JP Morgan, by the way, John Pierpont Morgan. So the question is, first question is, why do people give their names to their companies? I mean, there are all so many choices in front of you, right? So one thing that you might think that you give your name because you don't have any other options. You're just basically lacking creativity. So the easiest choice is obviously giving your name. However, this explanation is, I find it quite unlikely, because these guys are entrepreneurs, right? These are creative people by definition with some original business ideas. So I don't think they lack creativity. So giving their name to their company should actually mean something else. So there is actually the motivation for our paper was this AER paper by Belanzon, Chatterjee and Daly. I will call this BCD paper from this point onwards. So basically, they have a theory on why people put their names on their companies. So they build basically the idea is signaling. You're signaling something, and the signal here is the eponymy, basically your name, and you're basically signaling the quality of your company by giving your name. And obviously, there are benefits and costs. Whenever you are signaling, in equilibrium, there are some benefits and costs. These guys are associating their name with their business. So obviously, if you do well, you benefit from, I mean, there are monetary and non-monetary benefits. You obviously can have other business contacts. You can improve your business. Plus non-monetary benefits, you feel pride because your name is like renowned in a better way. You have a good reputation. But there are always costs as well. So if you fail, if your business goes bankrupt, obviously people will remember your name not as a bad signal, right? So if you want to start up a new company, probably you would rather not put your name again. Okay, so there are basically costs and benefits associated by putting your name, but basically putting your name really creates a big link between yourself and your company. So in equilibrium, what these guys find, BCD finds it, basically high ability entrepreneurs choose eponymy because they are able to face the consequences of the associated costs because they are highly skilled. And in what they predict is these eponymous companies should perform better in equilibrium. And empirically, they validate their theory. They find that eponymous companies on average perform better than non-eponymous ones. Okay, so this is the overall background theoretical setting. However, there are some conflicting results. After this paper, Guzman and Stern came up with two other papers. So they find that actually eponymous companies do not grow as fast as their non-eponymous counterparts, which is a bit like a contradictory finding with the BCD arguments. So if you're like a skilled person, if you're like a top achiever, your company should also grow fast. But they find that this is not the case. So growth in their paper is basically defined by either having an IPO or being acquired by another company within 6 years of your starting your business. So BCD then comes up with another explanation in their management science paper in 2020. They find that even they accept the fact that these eponymous companies do not grow as fast, but still, if you put glory and your reputation more in, then you put more emphasis on your glory and reputation more than your growth, then still in equilibrium, they find that there might be rational incentives for people to still put their names in their companies. And reputation basically here is the key word. And there is again a recent management science paper by Minicelli et al. They find that empirically BCD's explanation holds in their samples. They find that eponymous firms indeed have better financial reporting quality due to reputational concerns. Okay. And there's also another literature which is related to why people might put their names besides skill and quality. which is trust, which is trust and reputation, which has been especially important in finance after the major crash of global financial crisis in 2008, and also following several investment scandals. So reputation and trust, when you put your money, when you invest, basically, you not only expect performance, but also you would like to make sure that your money is in good hands. Okay, especially in finance, if in the asset management industry, when you're putting your money in a hedge fund, mutual fund, or even in a bank, you want to make sure that your money is in good hands. So trust is an important part of this decision making. And surveys also across finance professionals. So we cite in our paper several surveys. They find that besides performance, reputation, and trustworthiness and integrity, like these are all intangible assets, which are key criteria for people, for investors, when they make their decisions. And there is a theory paper by Genaioli, Schleifer and Vishney in 2015. And they also, they try to address this question. So in the asset management industry, there are some funds which exist despite their delivering lower net of fee returns to their investors. So after fees, if you look at the performance of these funds, their performance is not really great. Actually, they perform worse than either investing in your money in an ETF, exchange-traded funds, or in the S&P 500. So you could have got much better returns if you invested in those alternatives. So why do people still put their money in those expensive funds and still accept to get lower returns? Their explanation, again, this is a theory model, is the key in their model is trust, because these guys offer some sort of like a peace of mind to these investors by delivering trustworthiness, by making sure that investors' money is in good hands. So investors, in exchange of this trust and dependability, they are willing to accept lower net of fee returns. Okay, so they are basically accepting to have lower returns compared to other benchmarks. By the way, I forgot to mention at the beginning, so feel free to interrupt anytime, so you don't need to wait until the end. So if you have any questions, if there's something that is not clear, feel free to jump in, either using the chat box or with your unmuting yourself. So anytime you can go ahead. So this is the another dimension that we had in mind. So this is actually the major revision that we had before. We didn't have this trust-based model. So, but again, we were still questioning. Actually, our first results were in contrast with what BCD found. So we did not find higher performance of hedge funds, eponymous hedge funds. So remember, their model was predicting that these guys are skilled. These guys want to signal their quality by putting their name. We wanted to test this in the hedge fund setting, and we found opposite results. We found that the risk-adjusted performance of eponymous hedge funds were not that great. So then we started thinking about what could be the reason of this conflicting results. So this was more of like a non-result paper at that time. And then we wanted to have a story, some rational explanation of, again, why these funds exist, despite delivering low returns. And Genaioli paper really fits into this explanation why eponymous funds could still exist despite delivering lower performance. So they could also be signaling managerial trustworthiness or integrity. So if you're integrated with your fund, if you signal that you want to financial misconduct, or you're going to have ethical behavior, signaling this trustworthiness to your investors is important for investors who value this trust. So by putting your name, again, this could be another signal besides skill and quality. So you might be signaling that you are a trustworthy person, you are a person that you can rely on, because you put your name at stake, right? If things go bad, if you screw up, so you are going to have a bad reputation. So your reputation is at stake. By putting your name, you basically are telling them, signaling them that you are a trustworthy person, investors can rely on them. So this is the alternative explanation. So we are going to basically test this two potential explanation in this paper using the hedge fund setting. So we are going to see whether eponym is related to signaling of performance as suggested by BCD 2018 paper, or is it more like signaling the trust-driven reputation managers' integrity in running their fund as suggested by GSV paper. So I'm just going to briefly go over the related literature on why a firm's name is important. Remember, the naming decision is actually one of the few decisions where entrepreneurs have ex ante before starting up their businesses. So most of the decisions are like ex post decisions. Once you start up your company, and you have to consult it like to other people, you have to get opinions of other stakeholders, or if you have other partners, you might want to consult them. But even like if you're working with teams, you have employees, unions, shareholders, all these people, your investment decisions will be based on your consultancy with those stakeholders. But before setting up your firm, naming your company is one of the few decisions that you do it on your own, most of the time on your own. I mean, you can again go to like a consulting company and want to find in exchange of some fee, you can ask them what the name of your company should be, but usually the process is this way. I know it personally because before doing my PhD, we started up a company, and actually the company had an eponymous name, so we used our initials for our company. So basically, this is a decision that you have to make. And in the literature, actually, the people find that this naming decision is actually a strategic choice. So it goes back to all these Krebs 1990 study. Basically, he finds that, or he has an equilibrium model, an asymmetric information model, and basically in these models, suppliers create a firm. So there's supply of firms and demand for firms, and suppliers of firms, basically they create this firm because trust and reputation is built on the firm's name. So basically Krebs identifies firm as a bearer of reputation, which is in line with our setting. Tadelis then has some follow-up papers in AER and Journal of Political Economy, which builds on Krebs' idea and develops a model to show that in equilibrium, firm names are valuable and tradable assets. Basically, when you trade your firm, when you sell your firm, for example, to another company, when your firm is acquired, your name of your company is also a tradable asset. So it's because it's a reputation. If you would like to buy, for example, Tesla or Apple, you don't only pay for the high-tech know-how that these guys have, but they also have the name of the company has a value. Okay, so it goes also like an intangible asset that represents the reputation of the company or the value of the company that it has on the eye of clients or other stakeholders. So name of the company is quite important, and there are other related papers, which I'm not going to go in detail. But so in the corporate finance literature, there are some studies that already look at this naming decision, and they identify that firm's reputation is a major component, major factor that affects this strategic choice. And in the asset management literature, there are also several studies, which are studies related, which looks at most of the time how the name of the fund relates to the flow to these mutual funds or hedge funds in the asset management industry. For example, Cooper, Gulen, and Rao, in their JF 2005 paper, they find evidence that if a fund name changes, for example, if a fund chooses a popular fund style, like if value investing was popular in like mid 2000s, so if a fund names it like value investing fund, so they find that there actually investors put more money to funds which have these popular investing styles. Or if investing in distressed companies is popular at one point, if you name your fund as distressed securities capital management fund, investors basically respond positively by putting more money in those funds. So fund name, basically managers again can strategically choose their fund name, but in expecting that they're going to investors will respond positively. There is also another study by Green and James, which I already mentioned, Kumar et al. Interesting study. They look at mutual fund managers with foreign sounding names. For example, my name is a Turkish, or at least a foreign sounding name. It's not a French sounding name. So if I set up a mutual fund company in France or somewhere in the UK or in the US, basically I should expect to get lower annual funds, because people usually do not trust, especially they find it after 2001 attacks in the US. They find that foreign sounding names, funds which are run by those managers with foreign sounding names, have lower annual fund flow. So people do not really trust in a name where they don't find familiar. Okay, so again, a name meaning your company can have significant impact on the money, on the flows that you can receive in the asset management industry. There is a recent working paper by Joanne Vara and Tew, and they look at the hedge fund setting, so similar to ours, but it's in a different setting. They look at funds whose names exhibit gravitas, and gravitas they define it as a combination of words from geopolitics or economics or suggesting power. So if your name is like suggesting some sort of power, and then they find that these funds again attract more flows. So investors value those funds and put their money in those funds flow by putting more money. And again, the other literature that our paper is related to is how trust is important in the asset management industry in financial institutions. Based on the GSV paper, they have a theoretical model that shows that investors value trust besides performance. Based on their theoretical predictions, Kostovetsky, actually, RFS 2016 paper, they find that indeed mutual fund flows turn negative. So investors withdraw their money from those mutual funds when those mutual funds announce some changes in their mutual fund parent company or their fund advisor owner changes. So these are again some events associated with the loss of trust in the fund. So that when there are sudden changes in your the mutual fund's parent company or the owners of this advisor, then investors basically withdraw their funds because they lose trust in the fund. And again, the recent RFS paper by Gürün, Stoffman, and Jonker, they look at this Madoff Ponzi scheme and find that after this, basically, this Ponzi scheme was discovered, which was result in a break of trust in the financial advising industry. They find that investors indeed move their capital from money managers to relatively safer banks. So trust is important, and it has some important implications in terms of fund flows in the asset management industry. So if you break the investors' trust, then there are some consequences. So this brings us to the question why we use the hedge fund setting to study this eponymy decision, which has been already studied in the corporate financial setting. We believe that hedge funds offer a unique setting to examine the implications of eponymy due to several reasons. First, hedge fund business is strongly entrepreneurial. So the guys who set up these hedge funds are, again, individuals, some entrepreneurs who set up these hedge fund business. So there's strong entrepreneurial business. And secondly, actions and outcomes for the agents, which are the hedge fund investors, and the principals, which are the guys who are running the hedge fund company, are more observable and measurable in the hedge fund industry compared to a corporate financial setting. So we can observe funds performance, their portfolio holdings, their risk-taking behavior, as well as investors' response to the fund's performance or any changes in their characteristics, risk-taking behavior. So we have plenty of measures. And obviously, for our study, the measures that we are more interested in is measures related to reputation, trust, and managerial integrity, which are not so easy to measure because these are intangible assets. So by definition, we do not observe them. It's difficult to measure a reputation of a person or trust of that you have in a company. But in the hedge fund literature, there are several measures that have been offered in the literature, like operational risk, funds fraud risk. So there are some measures that can proxy for a manager's ethical behavior or trustworthiness, which again enables us to test this potential relation between eponymy and integrity. Remember, we were looking at two potential explanations. Eponymous funds, do they perform better, or maybe they signal trust or integrity to their investors? So another measure that hedge funds setting offers us is the investor fund flows. So we can observe what investors, whether they put money in funds, more money in these funds, or whether they withdraw their money from these funds. So by looking at if a manager breaks investors' trust due to engaging in, for example, a violation of regulations or some violation of laws, civil or criminal law, you might break your investors' trust. And then obviously what we would expect would be investors would punish you by withdrawing funds from your company, right? And the opposite holds true. If you can manage to preserve your investors' trust, you should receive more fund flows to your company. And we can observe this. So there are some observable measures that helps us test these potential explanations. And the last point is hedge fund industry is relatively opaque compared to mutual fund industry. There is less regulation, so which makes it more challenging for investors to obtain necessary information. So if there is an asymmetric information between the manager's skill or trustworthiness, so any signal that you can have that signals managerial quality or managerial trustworthiness is important. And hedge fund industry, that's all, again, that's why studying hedge fund industry is important. So our contribution is basically we are testing whether economy in the hedge fund industry is associated with superior performance, which is driven by managerial skill, first explanation, and or whether economy in the hedge fund industry is associated with trustworthiness and ethical behavior driven by managers' integrity. And we provide a formal test of benefits and costs associated with economy, and we extend the literature on economy and the role of trust in the asset management industry. So the main research questions that we are asking in this paper is, do eponymous hedge funds perform better than their non-eponymous counterparts? Are eponymous hedge fund managers necessarily skilled? Is economy related to managers' trustworthiness, ethical behavior, and integrity? And are there reputational benefits and costs associated with economy in the hedge fund industry? By the way, how am I doing with timing? I think I'm half an hour more or less, right?
You can use your time, so no problem.
Thank you. So if I cannot manage to finish on time, so basically this is our results in a nutshell. So what we find in this paper, so we control for a host of fund characteristics, and even using these controls, what we find is eponymous funds actually do not generate significantly higher returns. So they don't outperform. We use different measures of performance in the hedge fund setting, like their returns, risk-adjusted returns, alphas, or MPPM stands for manipulation-proof performance measure, because hedge funds are also have a bad reputation that they can manipulate their returns. So we use another measure of these returns, which is more resilient to manipulation. And neither of those performance measures show us that these guys generate superior returns or superior performance compared to their non-eponymous counterparts. And instead, what we find is actually these eponymous hedge funds exhibit much lower Sharpe ratios and information ratios, which signal that worse risk-adjusted performance. So these are like performance measures adjusted for risk. So if you take into account the risk they're taking, actually they do much worse than their non-eponymous counterparts. So we simply do not find evidence that supports BCD setting theoretical framework. Remember, in their theoretical framework, you put your name because you would like to signal that you are a highly skilled ability entrepreneur, in this case, a hedge fund manager, but we don't find it in the data. Okay, so these guys are not necessarily skilled or they don't exhibit superior ability. So despite these lower risk-adjusted performance, the question is, how come these funds exist in this very competitive industry? We find that actually these guys also have very peculiar characteristics. They also have significantly lower operational and fraud risks, suggesting us that the economy is not related to performance, but mostly it is related to trustworthiness, ethical behavior, and integrity in the hedge fund setting. Okay, and we also find the supporting evidence when we look at the fund flows. We find that investors indeed punish eponymous funds by withdrawing their money from those funds if they break their trust by violating regulations and laws. So there are reputational costs associated with enemy, plus there are benefits as well. So they put money in those funds which preserve the trust of investors so if you are a fund which do not violate regulations, if you behave well, basically investors reward you. But if you do not behave well, if you violate regulations and law, then investors punish you by withdrawing your money from your funds. So this again confirms our trust-based explanation. So trust is important, and eponymy, and this effect is much stronger for eponymous funds. Remember, I'm going to show you the results. So this is only specific result for eponymous funds. We don't observe it for non-eponymous funds, for example. So if you put your name in a fund, and on top of it, when you put your name, if you break the trust of your investor, again, you're breaking basically investors' trust. So you need to bear the cost, and that's what we observe in the data. So investors react very significantly to these kind of events. So overall, our results suggest that eponymy serves as a signal to investors who value trust and seek managerial integrity besides performance. Actually, performance is not the main explanation in our setting. So I'm going to skip the data sources. We use standard data sources in the hedge fund literature. And especially for measuring integrity and trustworthiness, we resort to Form ADV filing. So Security Exchange Commission requires hedge funds since 2006 to file these information. So these are all information about their ownership in the fund, whether they have outside ownership, the performance obviously of the fund, but also like whether they have been associated with any regulatory, civil, or criminal violations. They have to report all this to SEC. Okay, so we can get all this data. This is also the benefit of studying hedge fund data. Plus, we also have some like managerial data, because we would like to also understand maybe there are some characteristics that lead to the eponymous decisions, such as managers' age, gender, or their education level. So we also use these managerial characteristics using who is who on LinkedIn data. So let me just briefly show you our identification strategy for how we identify funds as eponymous or non-eponymous. So we have basically 4 criteria. Eponymy 1 is the most strictest definition of eponymy. So we simply look at the fund's name, and then we look at the manager's name. And if the fund's name matches either the first, middle, or last name of the founder, then we identify this as an eponymous hedge fund. So for example, if you, Mehmet, if you set up an Umutlu hedge fund, then this fund will be identified as an eponymous fund in our data set. And we will call this eponymy 1 variable. Then something particular in hedge fund setting is you have funds that investors invest, but these funds also have their parent companies. They're called the investment company. One investment company can run multiple funds, basically. Here in the eponymy 2 definition, we also include those parent companies. So you might have an Umutlu hedge fund parent company, which might or might not have eponymous funds in the running under your parent company. Okay, so but investors know who is the owner of this parent company, and when they're investing in a fund, they know that if it is like Umutlu hedge funds, then they know that the money that they're putting in one of the funds that is under this umbrella fund is run by an eponymous manager. Okay, so here this is the distinction between eponymy 1 and 2, but we only look at the first, middle, or last name of the founder. So we do the matching using this. Eponymy 3 is a broader criteria, not only the name, but we also use the initials of the hedge fund names. So if you set up a company, MU hedge fund company, this also goes for to our eponymy 3 definition. You only use the initials of your name. Okay, or if you have some partners, you can also combine. So if we set up a hedge fund company, MUEA hedge fund company, then this also goes to the eponymy definition. So using initials also is in this broader definition of eponymy is also taken as a eponymy decision. Okay, and our main eponymy variable is eponymy 4, which is including both the names and the initials of the fund and the parent company of the fund. Okay, we are using this in our main test, but our results are not sensitive to the choice of eponymy. So it's we are using this because this is the broadest category, so we can cover much larger data set, which actually is working against us. So, and this signal, you can think that this signal with the initials might not be that strong than putting your name directly, but it holds even for eponymy 4, and the results are even stronger for the other. So here we have a larger sample. That's the only decision for us. So that just to show you in the hedge fund industry, you might wonder, maybe this is not something really worth working on. Maybe this consists only a tiny fraction of the hedge fund industry, so it might not be worth bothering what is this, whether this decision is important or not. But actually, this is not the case. So many hedge fund companies, so we have a list of the top 30 hedge funds in the as of 2021. If you look at their assets under management, 7 of those funds are actually eponymous hedge funds based on our eponymy 4 definition. So you see that DE Shove Group, number 6, managing close to $40 billion of assets. Number 10, you have Davidson and Kempner, founded by 2 partners. Marshall Wace, again, founded by 2 partners. Baupost Group is an interesting case, number 13. So as you can see, they put the initials of the 4 founding partners. So B, A, U, P, O, and S, T makes basically Baupost. And this is also according to our eponymy 4 definition. This would count as eponymous fund. If we use the eponymy 1 definition, this wouldn't be in our setting, in our data set. Okay, so according to our definition, there are 7 funds out of the largest 30 funds in the hedge fund industry, which are eponymous, which means that eponymy is not something uncommon in the hedge fund industry. So it's worth examining. And in our data set, what we find is using the eponymous for criterion, roughly 8.7% of the funds are eponymous funds in our setting. So it's a sizable amount. And it's important to see why people give their names to their hedge funds and whether they have differences in their performance or whether they are signaling something else by putting their name. So we have like a sizable sample there to study these questions. Okay, so we start with the performance analysis first. We are basically testing the BCD theory here. And in the univariate analysis, what you can see is actually there's some sort of confirming evidence. So you can see that eponymous funds performance in terms of raw returns or alphas or manipulation-proof performance measure, it is higher than their non-eponymous counterparts. And the difference is significant, statistically significant. So, but this is a univariate analysis. We are just looking eponymous funds versus non-eponymous funds without any controls. So there might be lots of other things that can explain this difference in returns. But on the surface, first analysis, the univariate analysis say that some performance measures, at least those 3 performance measures, in terms of those 3 performance measures, eponymous funds are doing better than their non-eponymous counterparts. But again, if you look at the risk-adjusted performance measures, like such as Sharpe ratio and information ratio, they're doing significantly worse than their non-eponymous counterparts. So there is mixed evidence at the univariate level. Okay, so based on some performance measures, they do better, but especially as just for risk, they do worse than their non-eponymous counterparts. So we don't find fully supporting evidence in terms of BECD 2018 paper. But again, this is a univariate analysis, and there might be lots of heterogeneity in these eponymous funds and non-eponymous funds. So controlling for potential variables that can impact these performance measures, like such as fund size, other fund characteristics. Once we do a multivariate analysis after these controls, even these outperformance in the raw return, remember in the univariate analysis, these eponymous funds seem to perform better, but these outperformance disappears, having controlled for these potential characteristics that can explain fund performance. However, Sharpe ratio and information ratio, it's still they deliver significantly lower Sharpe ratios and information ratio even after controlling for this. So the outperformance, basically, we don't find evidence that support BCD paper. We don't find that eponymous funds outperform their non-eponymous counterparts. And in contrast, actually, they perform worse when you use risk-adjusted performance measures. Okay. Obviously, another concern here could be the matching. So when you're looking at eponymous funds and non-eponymous funds, they are also different in terms of many different aspects, like their sizes could be different, or there can be other fund characteristics that might create this potential difference, or the results might be driven by other characteristics that can drive the heterogeneity in eponymous funds and non-eponymous funds. So to control for any potential unobservable factors that can create this heterogeneity, we use a matching procedure, but we use entropy balance matching. So the most common approach in the literature is to use propensity score matching. So however, in the propensity score matching, I'm not going to go into technical details, but you basically give either a 0 or 1. So if like 2 treatment sample and the control sample, they match in terms of, like, for example, assets under management, in terms of the year that they were established. So if they don't match, you give 0, which means you discard the observation from your sample. So that has this disadvantage. However, the advantage of entropy balance matching is it's like a continuum. It's not 0 or 1 variable. It's a continuum. Hence, basically, it avoids this problem of discarding unnecessary, which could be some valuable information from your data set. So it's a better way of matching procedure. So we use this matching procedure, and you can see that the matching does quite well, actually. So the treatment group and the control group, eponymous and non-eponymous funds, they are actually identical in terms of all these control variables. So having done this matching, we repeat this multivariate analysis, but still the results are almost the same. So the results are quite robust. We don't see, even in this match, using this match sample, eponymous funds do not outperform, and they still continue to deliver lower risk-adjusted returns. And then we were quite surprised by these results, and then we wanted to dig further. So these are like, we are just looking at monthly returns. So we wanted to see maybe short-term performance is not good, but maybe these eponymous funds are delivering better performance in the long run. So we wanted to look at their 2-year, 3-year, and 5-year performance. And even when we look at long-term performance, the results do not change. So both in the short run and the long run, eponymous funds fail to outperform their non-eponymous counterparts. However, they still deliver much significantly lower risk-adjusted returns in terms of Sharpe ratios and information ratios. So the result thus far offer little evidence on eponymy signaling skill, right? If you are a skilled manager, obviously, again, we cannot measure skill directly. We can measure the output of skill, which is performance directly. So, but the output basically is not there. So these guys do not, if they are skilled, they should also have some better performance output, right? So then we look at the, again, hedge fund industry offers some measures that can proxy for skill. Again, it's difficult to measure skill, but there are some measures like the R-square measures of Titman and Yu, strategy distinctiveness index, and unobserved performance of measure of Agarwal, Wenzi, and Weigert. So these all signals. So if you have like a when you regress hedge fund returns with some common Fungan CS7 factor model, if you have a low R-square, basically this is a signal that you might have a higher skill because your returns are not that captured by common factors. So you are adding something more than the captured by those factors. Or strategy distinctiveness, if you look at your returns and the return of the style that you belong to, and if you look at the correlation between them, so the higher this correlation is, then again it signals you're a skilled manager. So we look at those 3 measures of skill: R-square, SDI, and up. So the lower the R-square, the higher the strategy distinctiveness index, and the higher the up, normally the more skilled the manager is. But we see that. So we have a question. The sample period is from, sorry, I think I mentioned it quite fastly, from 1994 to 2018. So the starting point is dictated by the hedge fund data sets. Basically, most of the hedge fund data start reporting in 1994, and 2018 is basically the most recent data that we had when we started this study in 2020. So it's a relatively long sample period, almost 26 years of data there. So we find higher R-squares, lower SDI, and lower up, which all again works on the contrary of these are signals, indications of lower skill in the managerial, in the hedge fund industry. So if anything, these guys are not skilled. And if anything, they are even less skilled than their non-eponymous counterparts. So then, obviously, we were struggling to interpret these findings. So these guys do not outperform. They do not seem to have skill as opposed to their non-eponymous counterparts, and they still exist, right? I mean, as related to your question, in our data set from 1994 to 2018, we see like all these 10% of funds are eponymous funds. So normally, if suppose you're an investor, right? You're putting your money in an eponymous funds, you see that you don't get the return that you want. And you see that they are delivering much lower returns in taking into account the risk that they are taking. And you also, by looking at these measures, you can figure out that these managers are not that skilled, or maybe there's not a significant difference between their skill between non-eponymous counterparts. So why do you still go and put your money? How come these funds can exist in such a competitive industry? So hedge fund industry is really competitive, and these guys still exist. So our explanation is they are actually offering like another intangible service to their clients besides performance, which is trust and dependability. So by putting their name in their hedge fund, actually they are signaling to investors that I'm a reliable person, you can trust me, I'm not going to break your trust, I will follow regulations, I won't break law. And so this is the signal that is given by this eponymy decision, by putting your name in your hedge fund business. Okay, and then we would like to test this, whether this is the case or not. So if it's not performance, could eponymy be signaling managerial trustworthiness and integrity? And then we test this. Obviously, testing this requires some observable measures. As I said, these are all intangible assets, right? Trust, integrity. So you do not observe them directly. But hedge fund literature offers some measures, which I'm going to come. But our hypothesis is this: basically, if you're signaling trust, Basically, you are telling your investors that you are taking the appropriate operational risk measures to manage the fund's operational risk to preserve their trust, or you're not engaging in suspicious activities like manipulation, fraud, or financial misconduct, like in the mud of investments. So you're not basically doing this, you're preserving investors' trust, and you signal them that you're not going to break their trust because your name is at stake again, which is an important decision. If you break their trust, and if people if you have a bad reputation, if so, now everybody knows Madoff, right? This guy, I don't think anyone would put their money to this guy's fund. If this guy is able to start a new fund, no one will put their money. So it's a quite costly, there should be costs associated with this. So we are also going to test this reputational benefits and costs. But this is the idea more or less. So if you're putting your name at stake, then and if you're not delivering performance, basically one suggestion, one alternative explanation could be that you might be delivering another service, like in the lines of GSV paper. So you might basically, for investors who value trust in this business, then putting your name can be simply serving for this purpose. And then the question is, how do we measure this trust-driven or integrity-driven reputation? So there are two measures that we use again for why we resort to the literatures, or this Form ADV filings that I mentioned in the Security Exchange Commission. We can extract this data, whether a fund manager violated SEC regulations, or even civil or criminal law, whether you had a speeding ticket in your car, or whether you didn't pay your taxes. So all these are reported. So if you violate laws, regulations, these should be filed with the SEC. So we can get this data. And there is another measure called Omega score, which was introduced by Brown et al. 2019, which is related to the violation. They look at observable fund characteristics which are correlated with these violations. So it's like a byproduct of this violation. So they look at violations of criminal and civil law or regulations, and look at they pick the characteristics, fund characteristics that are most correlated with these violations in the Form ADV filings, which is called the Omega score, basically. So we also use this. So these are accepted as like two important measures of operational risk. So the higher these risks, these measures are, the higher that your fund is subject to operational risk. And there's again, there's the higher the likelihood that your fund will either go out of business or you're going to lose your money. And there also, we follow Boland and Poole 2012 paper. They suggest not only those 4 measures, but we use those 4 measures, but they suggest, I think, 12 measures of fraud risk, mostly looking at the hedge funds reported returns. So they look at the distribution of hedge fund returns, and you can get those, for example, 4 characteristics. They can identify whether those return patterns are suspicious looking or not. For example, they look at the kink. Kink is basically the discontinuity around 0. So most hedge fund managers can or might have tendency to manipulate their returns, most of the time by not reporting negative returns, rather reporting positive returns. So they might play around with returns. So if you have some sort of discontinuity around 0, so some of the returns below 0 are shifted above 0, then you are going to have a discontinuity. So we look at basically, they suggest this measure. Also, like if you have lower frequency of negative returns compared to positive returns, or you have plenty of returns that repeat themselves, these are all indications of suspicious return patterns. So compared to like a normal distribution where each observation is like, or uniform distribution where each observation is equal or likely, if you have some like concentration in like the negative returns versus positive returns, or some returns that constantly repeat themselves, which is like deviation from a certain distribution, then these are all identified as suspicious return patterns, which can potentially signal fraud risk. The hedge fund manager somehow like window dressing or manipulating their fund. Max R-square is similar. So they regress hedge fund returns to some well-known factors. And if these adjusted R-square of the fund is not significantly different from 0, which cannot be identified by some factors, which again is a signal that there's something suspicious in these return patterns. So these are called performance flags. So whenever you have this kink, discontinuity, or lots like very low number of negative returns or high number of repeated returns, or an R-square which is not significantly different than 0, then you have this performance flag. It's like a red flag. It's a flag that shows you that you should be careful. Like these returns do not look normal. They look suspicious. So we use this, and they basically show in their paper that the funds which have this higher king, much lower negative returns that repeat themselves, and with R squares which cannot be differentiated from zero, they are much likely to have fraud in their business, and they are much likely to fail. So we use those measures as measures of integrity or ethical behavior, or whether the fund manager is engaging in misconduct in their businesses. Okay, so we use those 6 measures. So again, we start with the univariate analysis. And if you look at these operational risk measures and performance flags of eponymous funds versus non-eponymous funds, we see that all these 6 measures are significantly lower for eponymous funds. Okay, which already gives us a suggestion that our hypothesis, which supports our hypothesis based on this trust. So these guys exhibit much lower operational risk. They do not violate laws, regulations as much as their non-eponymous counterparts. They exhibit much lower omega scores. The discontinuity in their return distribution is much lower, and so forth. So they have these performance flags raised much lower than the non-eponymous counterparts, which all suggests that they engage in less suspicious activities, less fraud risk, and they have less operational risk, which are all related with trust, right? So, I mean, this is quite a strong result. All these eponymous funds have significantly lower risk measures. Obviously, this is again a univariate result, so there might be lots of confounding factors which might drive these results. We again control for a bunch of hedge fund characteristics, and even after controlling, we still have the same results. So eponymous hedge funds have significantly lower operational risk and fraud risk compared to their non-eponymous hedge fund counterparts. So far, we basically show that eponymous funds are less likely to engage in non-ethical behavior, fraud, misconduct, or regulatory, civil, and criminal violations. This is in line with GSV paper, right? Remember, in the first set of findings, we find that these guys don't outperform, don't deliver superior performance, but they also deliver much lower risks associated with fraud or operational risk or violations, which are all measures of trust and dependability, right? So you can basically trust those guys, because if you are an eponymous funds, the data already speaks for itself. You see that the eponymous funds have much lower fraud risk and operational risk. And then we would like to dig further, obviously do some further robustness tests. And in terms of time, I think I don't have too much time. I might have skipped this maybe. So we look at the manager's name rarity, just to give you an idea, because again, in the BCD paper, they find that if your name is rarer, so it's like not a common name, then remember this, you're always creating an association between your name and your company or your hedge fund. So if your name is rarer, this association is even stronger. So if you fail or if you have a bad reputation, people will even remember you more strongly because your name is so rare. It is recorded in investors' mind in much strongly than a common name. So they will remember those rare names much more. And that's their hypothesis. They test basically whether managers with rare names perform even better than managers with common names. That's what we do. So our hypothesis is that if you are a hedge fund manager with a rare name, so your name becomes even more important. So you would be even more careful in not breaking investors' trust or their trust in your fund. Okay, so and that's what we find. We also look at another test because remember there are some funds. You can be an eponymous fund manager, but you can run multiple funds. And some of your funds, obviously, you cannot give your name to all of your funds. Maybe some of your funds are have different names, not your name. Okay, so we look at non-eponymous funds run by eponymous managers. So, for example, Umutlu Fund, you might create one fund called Umutlu Fund. Then you are successful. You can create another fund called Value Investing Fund. So we look at basically the integrity measures of these 6 measures of value investing fund. And we find that even the non-eponymous funds run by the eponymous manager, they have similar characteristics, which is actually normal. Like remember this trustworthiness, integrity, ethical behavior, they are like personality traits. Like you cannot divide it. They are like unique, indivisible personality traits. So you cannot be trustworthy in one fund and then be untrustworthy in another fund. So this is what we should expect. If you are behaving in one way in an eponymous fund, so if you put your name in one fund, even in other funds, if you don't use your own name, you should behave in a similar name. So I'm going to skip those results for the sake of time, but what we find is managers with rare names. And if you are eponymous, you are again much less likely to violate rules or laws and regulations, much less likely to have lower omega score. And king, I just report the first 3 results here. And again, if you are a manager, eponymous manager running a non-eponymous fund, you are again much less likely to have lower operational risk and fraud risk. The last, maybe another important result that we have, which I can conclude after that, is the cost and benefits associated with breaking investors or preserving investors' trust. Remember, in the end, there should be some costs. Otherwise, everyone can put their names, right? If economies, funds, signaling, like if you are expecting like positive flows, if these investors value eponymous funds, which we find, then everyone can choose the economy, but there should be also some costs. And that's what we test here. If you break the trust of your investor, and if you are an eponymous funds, basically you should be punished by your investors. But if you still preserved in your investors' trust, then you should also be rewarded by investors. Basically, we look at the fund flows. So we look at the fund flows at next period, and we look at the performance, basically looking at different performance bins, high performance, middle performance, and lower performance. And we divide our sample into funds which violate and funds which do not violate. And actually, this is like the key result that we have. So we see that for eponymous funds, so look at this interaction terms. So eponymous funds that perform well in one period. But if you violate, if you're an eponymous funds that performed well, and if you violate, you see that your fund flows are negative, which means investors are actually punishing you. They withdraw funds from your eponymous fund because you violated, you broke their trust. But if you are an eponymous fund which did not violate, which means which you preserved investors' trust, you signal them that you are a trustworthy person, you see that there you receive significantly higher flows. So here, this is basically the punishment and the reward for between eponymous funds who violate and who do not violate. Which I think leads me to the conclusion, given that I'm already run out of time. So this is more or less the same slide that I've shown you before. What we do in this paper is, particularly in the hedge fund industry, we examine whether eponymy is related to managers signaling their ability or ethical behavior. So we find little evidence in favor of ability, skill, and superior performance of eponymous funds in hedge fund industry. Instead, if anything, basically they have even lower performance in terms of Sharpe ratios and information ratios. However, despite this lower performance, we also find that eponymous funds exhibit much lower operational risk, much lower fraud risk, suggesting that eponymy is associated with managers' integrity and trustworthiness. So, and consistent with this reputational cost and benefit associated with eponymy, we also find at the last slide that I've showed you, investors do punish eponymous funds in terms of fund flows if they lose investors' trust. So overall, our results suggest that eponymous funds serve as a signal of managerial integrity to investors who value trust, managerial integrity, and ethical behavior. So that concludes my presentation. If you have any questions, any remarks, it will be my pleasure to answer.
Eser Hocam, thank you very much for this very nice and interesting presentation. I liked listening to your presentation a lot. And it was a very recent paper, and it was a very timely study. We have taken very interesting insights from your presentation. And the main takeaway for me from your presentation is that I will start a Umutlu fund after your encouragement.
You should.
It sounds very well. So I haven't thought this before, but I will start to think that seriously after your encouragement. And maybe I can help you to extend your sample a little bit by this way. And
Sounds good.
we have a question from Oğuz Hoca in the chat box. He asks
Yeah, I think
strategy.
I saw it during my presentation. I think I answered it. It was from 1994 to 2018. So
No, I have comments. I have to contribute some comments if you have some time.
yeah,
Sure, Oğuz Hocam.
pleasure.
Please
If
go
you
ahead.
have, sure.
Yeah, let me open this video, I guess. Yeah. Thank you for your presentation. I mean, the topic interests me, I think, because of, I mean, not in particular sense of economicity, but more like idea is skin in the game versus convex payoffs, right? So if you are economists and hedge fund managers, you are putting your name on the. I have some. First, about the data. So, does a firm can enter the data? I mean, did you in your sample? Do you have like a firm has to exit throughout all period, or so? If I had,
we can have like hedge funds that can disappear which, due to different reasons, due to failure,
yes,
due to delisting, or due to simply they voluntarily do not disclose their
so they are
returns to the data.
right?
They are in the data. So we have like funds which are alive and
I
funds
think
which are
another
dead.
interesting statistic would be can be like the survival rate between eponymous and non-eponymous, right? I mean, that is the idea. If you are, I think that would be much. I mean, I find that very informative. I would find that, right? Because
yeah, I see your point. I mean, yeah, we didn't look at it.
The idea is risk, and I mean, if the economy guy is putting his name onto the board, I mean the table, whatever işte çerçeve yazıyorsa, that is one I think issue, and of course, but they brought return, right? Something comes to my mind. I mean, I am not very close to the performance literature nowadays, but most firms cannot create alpha, right? Most hedge funds. I mean, that is I mean, even so, beating the market is hard to do. So we should not expect economists ones to do that.
In hedge fund setting, actually, there are, I don't know, I cannot give you an exact ratio, but there are plenty of funds who can deliver alpha because their like business model is slightly different than mutual funds. So in mutual funds, that your observation is, I agree with you. Most of the mutual funds do not deliver alpha; they cannot beat the market. But hedge funds are quite specific because their investments are much like riskier, and they can use options like other sophisticated tools, derivatives, and they usually. There are like a significant amount of hedge funds which can deliver alpha actually.
Okay, thank you.
Yeah.
Yeah. Then, I mean, one comes to my another issue that what about our risk measure is wrong? I mean, sharply. I mean, standard deviation is wrong, right? I mean, and this idea is coming from what I will talk now. So, if we think about the possible clientele of these hedge funds, right? They are different, as you say, from the regular mutual funds. So at the same time, another question is, I mean, thinking in parallel, where does the value of the name come from, right? I put some I don't know, some brown guy put his name, but where is that? I mean, value. I think I would imagine that they have some previous history in another firm to start up a new hedge fund, right? So they are already known in some financial firm, or they already manage maybe as a fund manager in a brokerage, so on and so forth. So coming back to in clientele effect, I mean, not effect, but so the people who are investing, we can assume that maybe they are more informed or more financial literate or complicated, right?
Yeah.
Compared to the regular mutual fund investors. So they may have a different perspective about what they expect from the hedge fund, right? Then, yeah, of course, this coincides with your point, right? They value trust, they value other things, but yeah, and of course they are punishing them. So I think there should be maybe this as an idea. So you characterize. I mean, I think you did not discuss in your presentation. So you may think about how this thing looks like from the demand side of the hedge funds, right? So there, I mean, the hedge fund creator has a name established already, and maybe they have that, there's a value attached to that name, right? And then they, of course, they start, and I think entrepreneurially, they start their own firm, and of course, they put skin in the game. On the other hand, there is an investors outside, I mean, hedge fund investor who is not just return seeking, but there is also other variants coming into mind. Yeah, I mean, it's an interesting paper, and I mean, I think about, I mean, there are lots of issues coming with conflict of interest and agency issues in finance, and I mean, yeah.
No, thanks a lot for all these comments. If you have further,
I don't know if I made sense to you.
No, it makes sense to us. Actually, we try to address some of them. We didn't look at the survival rate. I think it's worth looking at survival rate.
Because I mean,
eponymous and
the
non-eponymous.
Okay, they are good on that, but it is more pure, I think, right? So if I am an investor, hedge fund investor who seek, so what is the other side? I mean, what's the big picture, right? So if the survival rate is, yeah, I don't know.
Yeah, we can definitely look at it. I mean, I would expect them to have higher survival rates, but again, we can look at this. Regarding the clientele,
add value, right? I think it will add value. Because it is a nice statistic, I think, from that perspective, from your story, right?
I agree. I mean, normally, so we should expect them to have a better survival rate than other funds, or if other funds have higher, like they're more subject to fraud risk and operational risk, they should fail more at least than eponymous funds. Maybe eponymous funds will also fail, but the failure rate of non-eponymous funds should be more than the eponymous funds. So that's something that we can look and.
Maybe you have done it, but maybe you can run on it.
We don't know this
before
analysis.
Financial crisis and after. Maybe there is a change there also.
Yeah, in financial crisis, I think like it hits most of the at the same time. But again, we would expect, based on our results, the eponymous funds
I mean, general market
less
changes after financial crisis, right?
Yeah.
So things get more correlated, and I mean, there can be, I mean, general market related. So that's it. I mean, thank you very much.
Thanks a lot for your comments. I really appreciate them. So we will definitely look at this survival rate, clientele effect. Actually, clientele effect and the like you mentioned, like their past experience. Maybe they worked in a bit different in an investment bank before, and they had some good success history in the fund, and then they established some sort of reputation, and then they. So
because otherwise, that wouldn't make sense, right? I mean, I mean,
try to address
value if we are attaching a value, there should be a source of that value.
Yeah, I mean, private past experience is one thing. So we try to get some managerial characteristics. We cannot find their past experience because they do not disclose. I mean, it's not a data that you can easily get. So they usually don't show their employment record previously. It's difficult to find these guys' CVs, but we at least can get their age, gender, whether they had a PhD or not, or whether they graduated from like an Ivy League school, like one of the top 20 US universities or not. So we gather this data. So these are all in the robustness checks in the appendix. We put these. And we also look at the clientele, whether they are more retail oriented versus more institutional investor, which are more sophisticated, as you said. So on average, we expect hedge fund investors to be more sophisticated than mutual funds. But even within hedge fund investors, you still have like retail investors, like wealthy individuals, which might be relatively less sophisticated than institutional investor. Like if it is like a sovereign wealth fund or a pension fund who is investing in your hedge fund, then these guys should obviously we expect them to be more sophisticated.
Because
we look at all these effects.
I mean, I can see some motives, especially after 2008 global financial crisis, that I mean, some people may think that return is not just everything. I mean,
exactly. So that's actually our motivation as well.
I mean,
because you can still accept at least relatively lower performance if you know that your money will not be in good hands and it will be managed well. So you can accept maybe a relatively milder performance, but in exchange you get this trust or this reliability, dependability from the hedge fund manager. So which are captured, I think, by these like risk measures that we find. So regarding your clientele,
you can generate a new risk measure considering, I mean, taking your varied sector. I mean, the other risks, like you mentioned, operational risk and fraud risk. I mean, instead of just looking at standard market-based measures, maybe a different factor model type, a different, I mean, risk measure. Yeah, I mean, certain, you know, we have issues with standard deviation and so on and so forth, but yeah. Anyways, I don't want to take too much time.
No, I really appreciate your comments, and we'll try to address the ones that we did not address. So this is the aim of the seminar. So if you have any other suggestions, they are more than welcome.
One thing, I mean, it may not, this at the start, I took some note about IPO. I mean, is a success measure IPO and buyouts. I mean, does it really apply to hedge funds in that sense?
Hedge fund is relatively, it doesn't apply. This was for corporations mostly. Hedge funds either liquidate their fund and they stop their fund. They usually don't sell it to another person.
Yeah. And especially nowadays, I mean, no one, I mean, use equity, right? When the debt is so cheap, especially like last 10 years or so.
But hedge funds also use leverage. They can borrow and they can also invest by borrowing as well. So we control for leverage in their results.
Okay, thank you very much.
Thank you, Hocam, for your comments and suggestions. So any questions from the rest of the audience? So any questions, comments, suggestions? Okay, then I can direct my questions. Eser Hocam, I have read the paper that you sent us before the presentation. So it was an extensive work, and I congratulate you and your co-authors for this huge work. And it was also taking so much time and effort to go over all the details, because there are so many details in the paper, and I took some notes in order to not forget the points that can be raised. One of the thing is that in the data section of your paper, it is mentioned that eponymous hedge funds whose founders passed away a long time ago are excluded from the sample, as no connection between founders and decision-making process remains. And that is a very valid argument. I totally agree. But at the same time, this argument also makes me think that whether there are eponymous hedge funds that were sold to other entrepreneurs after their foundation, while the eponymous names were kept unchanged, perhaps because of benefiting from the prestigious names, and the new decision makers with different names start to manage the funds. In such a case, the connection between the names of the hedge funds and those of new decision makers will be lost again. I wonder whether you check this issue or you encounter such an issue in your sample.
We did not look exactly to the funds that have been established long time ago, like JP Morgan, Merrill Lynch, and like you have thousands of funds associated with JP Morgan, but JP Morgan is not running those funds, right? You're right. I mean, they are like other professional fund managers who are using this financial conglomerate, JP Morgan, as a brand name. But it's not JP Morgan who is signaling his ethical behavior or his skill anymore. It's like what was 100 or 200 years ago. So we try to address this by one test. We look at whether the hedge fund is affiliated with a financial conglomerate like JP Morgan. I mean, it can be. It also can be non-eponymous funds. It could be like a Citibank, Bank of America. So any financial conglomerate, not necessarily an eponymous like JP Morgan, Merrill Lynch, and others. So here, one thing like indirect test that we do is we control for in the robustness checks whether the hedge fund is associated with a financial conglomerate. The other thing, not in the paper, but in the previous version, we also looked at changes in the name. So there were some cases where the name of the fund changed. We don't know the reason. We cannot see whether it's due to like ownership change. Maybe it's the same owner who wanted just to change the name of the company, or maybe it was sold to another investor and these guys wanted to change. But there were some cases of name changes. And when you go from eponymous to non-eponymous, or from some non-eponymous companies chose to be eponymous. So we looked at these name changes, and the results were still in a similar what they have found. They still, any of those funds that did not outperform continued underperforming. Or in that version we did not have this trust, so we did not do this analysis for the trust-based explanation, but we only did this for performance-based explanation. So the results based on performance held for funds which had changes in their names in both ways, both going from eponymous to non-eponymous or going from non-eponymous to eponymous. But again, we do not observe the reason behind the name change. So we just observe that the name changed somehow at one point to the other. So there's no data on the reason of the change. So your question is valid, but we have some data constraints on that. So we cannot directly test, directly trace the main reason which led to name change. So we cannot really trace
maybe if you can pinpoint the name change, if you can date the name change, maybe an event study type of analysis can be also added to this study. By this way, you can just have a different perspective whether name change, as you have already mentioned, going from eponymous to non-eponymous or the other way around, may change the underlying dynamics. So that can be another thing to look at. My next question is about interpreting the findings in table 8, which is about flow integrity sensitivity. So if I'm not wrong, you interpret a negative significant alpha 3, which is the slope on higher performance times economy interaction term, as the indication that investors punish violating managers even if they performed well. So
this one, yeah, exactly.
I'm talking about the violating managers in the high performance category. So
this one, right? I think, can you see my screen? I'm sharing this.
Yes, exactly. So I'm talking about, for example, minus 0.611.
Yes. Yeah.
All right. And so this, for example, this coefficient is taken as the indication of punishment by investors of the violating managers, even if they perform well. But then I would expect to see a more severe punishment for violating managers exhibiting moderate or low performance. However, these are measured by alpha 5 and alpha 7, the mid performance times economy and low performance times economy interaction. However, all these alphas, alpha 5 and alpha 7, are all significant in all panels. And I wonder why violating managers that perform poorly at the same time are not punished, as opposed to violating managers that perform well. So what can be the reason behind this?
Yeah. I think the potential explanation is we don't see it for eponymous managers particularly, but if you are like in general a low performing fund, if you look at the flows, I mean, compared to a high performing fund, your flows are much less, first of all. So this is more or less in line, but this is regardless of whether you are eponymous or non-eponymous. Okay, so at least this is relatively consistent. So you don't receive that much flows after a lower performance. And if you're an eponymous fund, we still see that you, if you perform badly, you receive withdrawals from your funds. And these withdrawals are much less if you are like a trustworthy fund, you're not violating, and higher in terms of coefficients, they are there, but they're not significant. This might be due to sample size. Maybe we don't have that many. So in terms of coefficients, we still have some like results that confirms that these guys are punished, even if they don't violate. So they lose some of the funds that they have after a low performance, or even after a low performance, like they receive much lower funds compared to a fund which have a better performance. So this is, I think, relatively, I mean, it's not exactly in line what you're saying. So you are saying that we should have even higher and more significant coefficient or punishment here. And so we don't have a significant, well, maybe the punishment is here. So maybe the punishment is in the low performance. So they don't care if you're performing low, actually, probably they don't care whether you're eponymous and non-eponymous, because they care that they see that they are losing money, right? So they don't really distinguish whether you are eponymous or non-eponymous funds. So the significance is not there. So that's and this is not, but if you are performing well, so which is something good, and if you break their trust, so you're in a state, in a like good state of the world, and you have like a shock, negative shock coming in a good state, then as an investor, you become more sensitive. Here, you are already in a bad state of the world. You know that the fund is already not doing well. So whether you are breaking their trust, whether you're not breaking their trust, it's of secondary order importance, because you already see that you are losing money. Okay, that would be my explanation. But the shock would be much more important if you are doing well and suddenly you learn that your fund manager engaged in some sort of financial misconduct, and then you would punish them. Even like the effect is that's what we see. So that would be my explanation. So the shock, the magnitude of shock would be much significant for an investor after a better performance than a worse performance. Here, basically, the performance is more important than your trust or your violation of their trust. When, however, you are performing well, actually the trust becomes much more important. So I think there's like a two factors that affect these fund flows: performance leg and the trust leg. So when you're performing well, trust becomes much more important, and then you're punished if you break this trust. But if you break their trust when you're performing already badly, investors probably are not so sensitive to this information. That would be the explanation. I don't know if it makes sense.
It totally makes sense, but there is something missing in this explanation, maybe, because the single coefficients for low performance and mid performance are positive, though not significant. So
they still receive flows on average.
Yeah,
but
yeah,
not as much as high performing funds, which are significant, and in magnitudes they are much higher, which makes sense. Usually, I mean, the sensitivity, flow performance sensitivity is after, if you perform well, you receive higher flows. If you perform badly, you still somehow receive funds, but not as much as a good performance. So this might be related to overall fund levels. So I mean, if there are some extra funds, I mean, if there's like an excess of funds in the industry, even if you're not doing that well, you might still maybe receive some funds, but not as much as good performance.
Does that flow variable, the dependent variable, shows the difference between the flows or the level of flows?
It's the difference. So this flow is again the definition table appendix. So it's your flow in year t+1 minus flow in t divided by flow in t. So it's the change in the flow relative to previous periods flow.
Okay, thank you. And another point, again related with this table, is that the inferences drawn from this table are mainly based on the results in panel A and panel B
Yes.
for row return and alpha.
The others are not that strong.
Yes, yes, that I would say that. So
True. So we acknowledge this, and we say that we provide evidence. So it's not like super strong evidence, but we provide some evidence on this investors' reaction to breaking trust versus, again, if in an ideal world, all the coefficients like here, we would have expected even higher punishment for lower performing funds, eponymous funds. So we provide some evidence, not exactly in line with what we would expect from the hypothesis, but there is some evidence that investors react to this breaking of trust versus preserving trust, especially in some cases when you use raw returns and alphas, we see this. And again, this would still make sense because think about you're an investor, the performance measure that you would use would be like the ones that affect your wealth is the raw return, first of all. Alpha would be the second importance. Risk-adjusted measures like manipulation-proof investors usually, at least manipulation-proof performance measure is on the academic measure, the investors definitely do not use. Sharpe ratio and information ratio could be used, but still it's not, it doesn't directly affect your wealth. So it's actually the raw return which affects your wealth. So if you put, say, 1 million euros to a fund, and if you get 10% raw return, then that's really what directly affects your wealth. So when you're making your decision, I think these returns, or like the way they decide their funds, this is our dependent variable here, whether you would like to put some money in a fund or withdraw money. I mean, I think these measures relatively are more important for investors than the other three. But still, again, this doesn't justify that we do not find somehow significant results for the other three measures. And we are honest about it. We just acknowledge that we provide some evidence, not super strong evidence, but especially when using raw returns and alphas, and especially when after funds perform well, we provide, actually, we see what we expected to see in the data, but it doesn't hold in all the performance measures. So I completely agree with you for MPPM, Sharpe ratio, or information ratio, and also in cases where performance is not that good. So we don't see always they are punished and or they are rewarded. There are some confounding factors, probably, again, as I said, maybe the trust is more important in good states of the world. So I mean, everything is going well, and then you suddenly break people's trust. I think the shock for you is much more important when, if things are already going bad, so things are already bad, so it cannot be even worse. I mean, the fund is already not doing well. So plus you heard that the guy already committed some crime or like engaged in misconduct. So probably the shock on your fund flow will not be, again, this is just, I'm trying to justify the numbers, but this might be the explanation. But these are not super strong results, I agree with you. But there is evidence, at least partial evidence, on this punishment and reward after breaking trust and preserving trust in some cases, not in all the specifications. But I agree with your point.
And one last comment, another question. One of the findings in table 1 is that most of the Eponymous funds are domiciled in the US. And,
okay, yeah.
Therefore, Eponymous funds may be attracting local US investors who might know about the founder or entrepreneur, whereas global investors might be unaware of local US founders. And if that is the case, then there will be less risk sharing with international investors in the pricing of Eponymous funds. And this can partly explain why Eponymous funds have lower Sharpe ratio as compared to their non-Eponymous peers. That is a thing that came to my mind. So, of course, maybe one can need some formal tests to verify the statement, but at least the initial findings seems to with this explanation. I just wanted to share it.
Actually, there are many different characteristics. If you look at the fund characteristics between eponymous and non-eponymous funds, most of them are quite significant. So they are much smaller, they have lower management fees, they have higher incentive fees. So there are plenty of different statistics, like the lockup period, redemption periods are quite longer compared to, I think this explains the trust base because they are able to impose higher lockup periods, higher redemption periods, higher notice periods compared to non-eponymous funds. Because if you trust your manager, you are willing to accept these like stricter regulations. So you are willing to accept that you cannot withdraw your money within like 4 months of time. So some of the characteristics explain US domicile, as you said. Yeah, this is an interesting question. Why it might be again a cultural issue. Maybe US entrepreneurs are more likely to put their name in their funds than non-US entrepreneurs. That's something that, but it could be also related to risk explanation that you mentioned. That could be interesting to test. So there are plenty of things to discover here, like also O's comments on the clientele behavior. They have relatively different clientele, and so I mean there are still things that can be worth investigating further. But yeah, that's a good point. Thank you.
Okay, and one last thing, I have extended a lot, I know, but
Sure.
I'm sorry if
I
you
don't complain on my side, but on your side,
okay,
you have
just
other commitments.
I just wonder the pragmatic investors. I just want to look at this issue from a pragmatic investor who is just interested in the final results. So
Yeah.
as far as I understand from your presentation, the investors are okay with low performance and they prefer honest fund managers. Okay, of course, honesty, trustability are surely very important characteristics that every manager, every human being should have. But you know, the investors are most of the time very impatient and they just focus on the results. So this brings the sustainability issue. So whether these eponymous funds will continue to survive in the future with low performance. Will only integrity or trustworthiness will provide them to survive, will allow them to survive in this competitive market. What do you think about the sustainability issue?
It is definitely related to all these new rising trend, ESG, like economic, social, governance issues. So here, I think the governance is the most important part than the performance part. So if investors put more and more emphasis on this sustainability, ESG, or trustworthiness, all these non-intangible values compared to tangible like performance, increasing their wealth, I think the trend is these days, like there are lots of investors who invest in like green companies, ESG funds, funds that don't invest in sin stocks, that invest in like green stocks. There are all these green bonds. So I think like my guess would be that trust will be still important, and it may be even more important than it is today. So that's, I think that's the, looking at the trend on in other disciplines of corporate finance, I think in the hedge fund industry, I would, although as you said that these guys would like to see materially some financial result as well. This, I think, theory by Jenny Ayole, Schleifer and Wishner explains like it's not always money. So even in the hedge fund industry or asset management industry, so it's only part of what investors seek. There are like intangible assets besides money. That's the message that we are trying to give. So we always use besides performance. So it's not, we accept that performance is important, but besides performance, these values like trustworthiness, integrity, ethical behavior, I think these are important, that at least in the hedge fund industry. And hedge fund industry is one of the industries which has been received lots of criticism due to financial misconduct, due to all these scandals. So even in this industry, if this exists, I think then there is good reason to think that these funds will still survive, and trustworthiness and all these like intangible values will exist. And I think they will be even more and more important, in my opinion. So the trend is in finance is shifting now from performance to other values, as you mentioned, sustainability and all this. And I think here we also, maybe we can also relate it to this literature. We show that in hedge fund industry, this sustainability one, like this trustworthiness related, definitely related to these values. So which shows its importance in even in this industry, which has been like received lots of criticism because of like investors like looking for immediate results and all this window dressing manipulation and all these scandals, Ponzi schemes. So it shows the importance. Like these guys don't deliver performance and they exist. So I think it's a good, hopefully, we can hope for these funds existing and continue their business.
Can I comment on this?
Yeah, please. Oh, yes. Sure.
I mean, there is this, I mean, my personal opinion, the last 15 years of finance is, I mean, whatever. I mean, we are in a central bank manipulated market. The idea is, I mean, it is hard to identify good fund manager in a bull market, right? There is this parable or thing, is a ship who goes fastest in the normal sea is a better captain, or is the captain who weathers the storm and reaches the port, right? So last 15 years of world markets is like central banks printing money, booming asset prices. So it is hard to, I mean, identify whether a fund manager is a good fund manager when the trend is positive, right? And I mean, everything about this, of course, it is easy. That is my idea, I mean, my point. Not necessarily because of ethics or I don't know, integrity or whatever, but I think, I mean, last 15 years of finance, I mean, there is no good adam gibi kriz olmadı yani şöyle. So there are fund managers who has a 15 years of experience who hasn't seen a good crisis, right?
Yeah.
So
We had the COVID crisis recently, so I think
no, it is not a crisis. I mean, let's focus on that. We will see many things. I mean,
but I agree. Yeah, with your point.
I mean, it is not about just. I mean, there are
purely financial crisis. Or...
Yeah, I mean, in economics, I mean, what we'll see. I mean, what will happen after. I mean, everyone's speculating nowadays about what Fed will do and so on and so forth. But
then,
I mean,
based on our results,
the
I
trend
think
is turning.
Yeah, if you're a fund,
actually,
yeah. Like if you're a fund which puts emphasis on your operational risk, which is like you have good practices in auditing, all the compliance, you like take good care of your fraud risk and all this, you are less likely to fail. I mean, it's an indication at least. We didn't see like a episode, maybe, as you said, maybe like a bear period. But these are all indications, like at least there's a correlation that whenever you have these low measures, you are more likely to survive. Although, I mean, we should definitely do this survival rate. So you are like more likely to weather the storm, as you mentioned in your own words. So these are like key like indicators that can at least predict how well a fund can do. So if you are all doing these operational risks and all in like following the best practices, then you are less likely to fail. You can still fail, but at least the failure rate, I would say, would be less. But I mean, we obviously, to test this, we have to have some crisis period, as you said.
I mean, my last comment was about not about your paper, but in general, I mean, I am also skeptical about all the regulations and stuff. I mean,
some of them, I think, help us still. All these like operational risk measures. I mean, always the regulators are always behind the practitioners, so practitioners find much better ways to overcome bypass regulations. But still, some of the measures relate to funds failure or in general a company's failure. So I think, but yeah, I agree with your comment. So it remains to be seen if, like, after a big crisis, maybe even those funds which take lower risk might also disappear. So
I mean, I think a huge systemic risk is coming, systemic risk event.
Yeah.
I mean, coming, or we'll see, but.
Yeah. But even in systemic risk, if you are better prepared for this risk in terms of risk measures and all this, at least we can expect those funds or companies which are better prepared to handle this risk better than the others. Obviously, most of them will fail, but there will be some who prepare better for this kind of risk. But I agree.
If there are no other questions, comments, or suggestions, we are approaching to the end of today's webinar. Okay. Thank you once again for your all efforts and explanations and your presentation. Thank you so much. It was a really great pleasure to host you as a speaker here, and hope in one day we will also have the chance to listen to you in person here at Yaşar University.
It would be great
if you're around.
Unfortunately, by the time you invited me, the situation was still uncertain, so I prefer to do it online. But I would have loved to do it in person. Hopefully, now the situation is getting better. So hopefully, I would love to be there in person. But thanks for having me. Thanks for all these great comments and suggestions, and thanks for the lively discussion. So it was a pleasure for me as well. So thanks for having me.
Okay. Okay, then I also want to thank to all audience for their time and for their participation, and hope to see you in the next webinar next month. Okay. Bye-bye now.
Thank you. Have a great weekend. Bye-bye.
Thank you.